Nigeria's oil industry transformed a small Dutch helicopter service into West Africa's most enduring aviation success story. But Aero Contractors' journey through 6 decades of political upheaval, economic crashes, and industry chaos proves that survival sometimes requires more than just staying airborne. Founded in 1960 by Schreiner Airways, a Dutch aviation company, Aero Contractors began operations with just 2 helicopters serving Nigeria's emerging oil sector in the Niger Delta. The company's timing was impeccable, as Nigeria's independence coincided with the discovery of massive oil reserves that would reshape the nation's economy. While most airlines focused on passenger routes between major cities, Aero Contractors carved out a specialized niche transporting oil workers to offshore platforms and remote drilling sites where conventional aircraft couldn't land. The company's Bell 47 helicopters, though modest by today's standards, represented cutting-edge technology for 1960s Nigeria and established Aero as the go-to operator for international oil companies like Shell, Mobil, and Gulf Oil, who needed reliable aerial support for their expanding operations. The Nigerian Civil War from 1967 to 1970 tested Aero Contractors' resilience as the conflict disrupted oil production and created dangerous flying conditions throughout the Niger Delta region. While many businesses collapsed during the war, Aero actually expanded its operations by providing critical logistical support to both oil companies and humanitarian organizations operating in the war zone. The company's Dutch ownership provided a degree of neutrality that allowed it to continue operations when locally owned competitors faced restrictions or outright shutdowns. By 1970, Aero operated 8 helicopters and had become indispensable to Nigeria's oil industry, which was rapidly recovering from wartime disruptions. The post-war oil boom of the 1970s transformed Aero from a small regional operator into West Africa's largest helicopter service, with the company adding Sikorsky S-58T and Bell 212 aircraft to handle increasing demand for offshore transportation. International oil companies were pouring billions into Nigerian operations, and Aero's helicopters became the lifeline connecting onshore bases to offshore platforms in the Gulf of Guinea. Nigeria's indigenization decree of 1972 forced foreign companies to sell majority stakes to Nigerian citizens, creating an existential crisis for Aero Contractors' Dutch owners, who suddenly faced the prospect of losing control of their African operation. The company navigated this challenge by selling 60% ownership to a consortium of Nigerian investors while retaining operational control and maintaining its international safety standards and training programs. This hybrid structure proved crucial because it allowed Aero to satisfy government requirements while preserving the technical expertise and safety culture that oil companies demanded for their high-risk offshore operations. The arrangement worked so well that by 1975, Aero operated 15 helicopters and had expanded into fixed-wing aircraft operations, adding DHC-6 Twin Otters for passenger service between Lagos and oil industry destinations. The company's success during the oil boom years wasn't just about being in the right place at the right time. It was about building a reputation for safety and reliability that became worth its weight in crude oil as international operators learned that cutting corners in Nigerian aviation often led to catastrophic consequences. The oil price collapse of the early 1980s devastated Nigeria's economy and triggered a wave of aviation bankruptcies that claimed dozens of airlines. But Aero Contractors survived by diversifying its services and doubling down on safety when competitors were cutting costs. While oil companies slashed exploration budgets and canceled helicopter contracts, Aero pivoted to emergency medical services, search and rescue operations, and cargo transport for industries beyond petroleum. The company's Bell 222 and AS-332 Super Puma helicopters found new roles supporting telecommunications companies building Nigeria's first modern phone networks and providing aerial support for infrastructure projects funded by international development banks. Aero's fixed-wing division also expanded during this period, adding Britten-Norman Islander aircraft for domestic passenger routes and cargo flights to remote airstrips throughout Nigeria. The key to Aero's survival during the 1980s recession was its refusal to compromise on maintenance standards or pilot training requirements, even when cash flow problems made these investments painful. While competitors deferred maintenance, operated with expired certifications, and hired underqualified pilots, Aero maintained its aircraft to European standards and continued sending pilots abroad for advanced training programs. The return to democracy in 1999 and rising oil prices in the 2000s created new opportunities for Aero Contractors, but also intensified competition as dozens of new airlines entered Nigeria's deregulated aviation market with ambitious expansion plans and deep-pocketed investors. Aero responded by modernizing its fleet with new generation aircraft, including the Eurocopter EC-135 for emergency medical services and the Leonardo AW-139 for offshore oil support, investments totaling over $200 million that positioned the company for the next phase of Nigeria's oil boom. The company also expanded its passenger airline operations, adding Boeing 737 aircraft for domestic routes and building a hub at Lagos's Murtala Muhammed Airport that served over 500,000 passengers annually by 2010. Aero's success during this period stemmed from its ability to leverage 5 decades of operational experience in Nigeria while adopting international best practices for fleet management and safety protocols. The company became the first Nigerian airline to achieve ISBAO registration for its helicopter operations and maintained IATA operational safety audit certification for its fixed-wing fleet, credentials that international oil companies increasingly required from their aviation contractors. The global financial crisis of 2008 and subsequent oil price volatility created new challenges for Aero Contractors as international oil companies reduced offshore operations and delayed new exploration projects throughout West Africa. Nigeria's aviation industry entered another crisis period marked by high-profile crashes, regulatory crackdowns, and the collapse of several major airlines including Bellevue, Sosoliso, and ADC Airlines. Aero survived this turbulent period by maintaining its focus on safety and operational reliability, while many competitors prioritized aggressive expansion and price competition that ultimately proved unsustainable. The company's helicopter operations remained profitable throughout the crisis because oil companies were willing to pay premium rates for operators with proven safety records and reliable maintenance programs. Aero's investment in modern avionics and satellite tracking systems also gave it competitive advantages in an era when Nigeria's Civil Aviation Authority began enforcing stricter safety requirements following a series of fatal accidents that damaged the country's aviation reputation internationally. The 2014 oil price crash and Nigeria's subsequent economic recession created the most severe challenges in Aero Contractors' history, forcing the company to ground aircraft, lay off workers, and seek emergency financing to avoid bankruptcy. Nigeria's currency devaluation made it extremely expensive to maintain foreign-manufactured aircraft and import spare parts, while falling oil revenues led to massive cutbacks in offshore helicopter operations that had been Aero's most profitable business segment for decades. The company's passenger airline operations also struggled with high operating costs, intense competition from low-cost carriers, and Nigeria's economic downturn, which reduced business travel and discretionary spending on domestic flights. By 2016, Aero had reduced its helicopter fleet from 25 aircraft to just 12 operational units and suspended several passenger routes as the company fought to preserve cash flow and maintain its core oil industry contracts. The crisis forced Aero to seek new investors and restructure its operations, leading to a partnership with Caverton Helicopters and other Nigerian aviation companies to share costs and coordinate services in the shrinking offshore helicopter market. Aero Contractors' evolution from a small Dutch helicopter service to Nigeria's longest surviving aviation company reflects both the opportunities and perils of operating in Africa's largest oil-producing nation, where political instability and commodity price volatility create constant challenges for businesses dependent on petroleum industry revenues. The company's current fleet of over 20 helicopters and fixed-wing aircraft serves oil companies, government agencies, and commercial passengers across West Africa, maintaining operations in Ghana, Equatorial Guinea, and other regional markets to reduce dependence on Nigeria's volatile economy. Aero's survival through 6 decades of Nigerian aviation chaos demonstrates the importance of maintaining safety standards and operational reliability, even when economic pressures make these investments difficult to justify in the short term. The company's reputation for safety allowed it to charge premium rates and maintain customer loyalty during downturns when competitors with lower standards were forced to compete solely on price in a race to the bottom that many didn't survive. Today's Aero Contractors operates in a fundamentally different environment than the small helicopter service that began flying Nigerian oil workers in 1960, with modern aircraft equipped with satellite navigation systems, sophisticated maintenance tracking software, and safety management systems that meet international standards for offshore operations. The company has trained over 2,000 pilots during its 6 decades of operations and established Nigeria's first helicopter pilot training academy, contributing to the development of local aviation expertise that now supports operations throughout West Africa. Aero's maintenance facilities at Lagos and Port Harcourt have become regional centers for helicopter and fixed-wing aircraft service, generating revenue from third-party contracts and reducing the company's dependence on volatile oil industry demand. The lessons from Aero's survival story extend beyond Nigeria's aviation industry to any business operating in emerging markets where regulatory frameworks are weak, economic volatility is high, and the temptation to cut corners can be overwhelming when survival seems to depend on minimizing costs rather than maximizing value. The future of Aero Contractors remains tied to Nigeria's oil industry, but the company's diversification into medical services, telecommunications support, and regional passenger operations provides multiple revenue streams that should help it weather future commodity price cycles and economic downturns. Nigeria's growing population and expanding economy create new opportunities for helicopter services in urban transportation, emergency medical response, and infrastructure development that could reduce Aero's dependence on offshore oil operations. The company's 6-decade track record of surviving Nigerian aviation chaos while maintaining international safety standards has created a valuable brand that commands premium pricing and customer loyalty in markets where reliability and safety can mean the difference between life and death. As Nigeria's oil industry matures and moves toward deeper offshore operations, Aero's experience with long-range helicopter operations and harsh environmental conditions positions it well to serve the next generation of petroleum exploration and production projects. The helicopter airline that survived Nigeria's oil boom and bust proves that in African aviation, longevity comes not from avoiding turbulence, but from building aircraft and organizations strong enough to fly through it.